Hi, everyone. My name is Ben. And
Everyone, my name is Bill. I'm a peer financial coach here with Smart About Money, and we are also with the Assistant Director of Financial Aid.
Everybody, my name is Kael Miyata.
we're going to be talking with you about sort of financial life post-graduation. A little bit about us. Smart About Money is a one-on-one and group peer financial coaching organization. We host workshops, presentations, as well as individual, virtual, and hopefully soon in-person consultations. We talk about everything from credit, student loans, to budgeting, and everything in between. We also host a number of larger scale events, such as our Cash Cab in the spring and our Family Food at Family Weekend in the fall. So first off, we're going to go through our learning outcomes. At the end of this presentation, you're hopefully going to be able to understand the student loan repayment process, how to build good credit and why credit is important, different tax filing strategies, differentiating between the different types of retirement accounts, primarily a 401k and an IRA, as well as creating personal financial goals for your future.
All right, awesome. So we're going to start off with student loans and talk about student loan repayment. This is a really important part of your life after college and understanding where your student loans are, how to make payments, and how to work out a plan that works best for yourself. So to start off, I'll give a general overview and then we'll have more of a conversation with financial aid about some of the options that we have. But throughout college, you've likely taken out a variety of different loans. Primarily, if you've taken them from the federal government, you've received subsidized loans where the government's been paying the interest. And then you've received unsubsidized loans where you're on the hook for the interest. But both loans you might not have had to make payments for because they've been in deferment until you graduate. However, after you graduate and that 6-month period comes up, you'll have to start making payments and the interest will no longer be subsidized. Plus loans might have been taken out by your parents. These loans, you might have an agreement where you're going to start making payments and things like that. So it's great to touch base on anyone that took out a parent plus loan and understand where those are. And then private loans. If you've had private loans, you know where these are because you've done the application through the bank's portal. You know which bank they're with. But these are administered by private lenders, and you'll need to get ahead and understand where these loans, how much the payments are going to be, what the interest rates, everything like that. And in general, if you have a mix of both your federal and your private loans, your federal loans are going to likely have lower interest rates and your private loans are going to have higher interest rates. So that's an important thing to notice and understand, kind of the payment differentiation between the two types of loans and understand how much and how long a loan is going to be structured for.
Another key difference between these types of loans is the federal direct Stafford subsidized as well as the unsubsidized are under the responsibility of the student. So when you signed a promissory note before your freshman year or whenever you started taking out your loans, those are sort of the student's name, as the parent plus loans are in the parent's name. So in the repayment process, some parents get confused and they think that the student loans for the parent plus loans are under the student's name. Well, that is incorrect. They are under the parent's name.
Good point. So the next one, we'll bring in financial aid for this, is so at student loans, you need to understand where your federal loans are. So if we'll bring in Kael for this, Kael, from a financial aid aspect, what can you recommend for students who have no idea where their financial, they've taken out loans, they have no idea where they are. How do they get a hold on them and how do they understand where their loans are held? Whether it's like, some students think they're held through UMass and that's not the case. So can you kind of go through that?
Yeah, so studentaid.gov is pretty much going to be your go-to location for figuring out any of this information. It's a pretty good resource because it compiles everything into one view. So you can find out, what subsidized loan have you taken out at one point, what is the interest rate, who's going to be collecting that debt in terms of a servicer. And you can pretty much figure out all the information on there. And on studentaid.gov, you can also figure out what kind of payment plans exist after you graduate. So it's a good resource to go to get general information. I was just actually talking to a student here they had completed exit counseling, so they just finished their undergraduate career. And one of the things that they're asking was, like, what happens when you graduate? So once you graduate, you have about 6 months after that before you have to start making payment, assuming that you haven't used up your 6-month grace period in the past by taking a semester off or things like that. So in that situation, I pretty much explained, you can go to studentaid.gov, you'll be able to see a breakdown all right there. And then once you figure out who is your servicer, so for example, there's organizations like Great Lakes, like Nelnet, for example, they're going to be in charge of collecting that money. So you would eventually create an account with them, and then you would start making payments. Your payments, assuming that you take out, let's say, unsubsidized loans from freshman year through senior year, might be about between high 200s to a $300 a month payment or so. If you can't make those, there are payment plans that you can go on with the federal government, and they're super lenient compared to the private sector. So all that information can also be on studentaid.gov. So I just kind of rambled on about a lot of information about studentaid.gov and general information about loans. But yeah, is there anything else that you had, Bill?
Yeah, no, that's great. If you go to the next slide, Ben, we'll just show a screenshot of actual what it might look like. This is taken when we're in the COVID forbearance period, and we'll get to that and a little bit more on repayment, but it just kind of shows the 0% interest rate, but we usually show the interest rate at which the loan is originated, the different disbursements of it, as well as what you have for principal and interest and how to get in contact with your loan service provider. But we can definitely go ahead, and the next one we talk about, kind of paying your student loans. But this is just kind of a screenshot of why it was. So Kael, this is more of your expertise here, is talking about, I've heard you talk a lot about like default and how flexible the government is and things like that in terms of repayment things and different repayment plans. So if you want to shed some light onto that, that'd be awesome.
Yeah, I can definitely do that. Can we go back one slide too, just because it caught my eye and I wanted to talk a little bit about that. Awesome. So on this page where it says on the bottom, right, mohila.com. So in this case, this is going to be your servicer, and that's who you're going to be making a payment to. There's a ton of, well, not a ton, there's a certain number of organizations out there that are in charge of collecting the money. Some of these, I don't know if they have as much funding. Their website might be, it might look like it's from, the 1970s or something like that. So, I think the key thing is to reach out to them if you have any questions. And if you're not really sure about the quality of the information that you're getting, you can probably find similar information on studentaid.gov, like payment plans, for example. And I'll go ahead and start talking about payment plans. Thanks for going back. So when it comes to payment plans and different options that you're going to have, let's talk about maybe a few different examples. Let's say that you graduate and due to COVID or some other reason or whatever it could be, you aren't able to find a job and you don't have income 6 months after you graduate, and you're going through kind of a difficult period, and you project that might go on for the next, let's say, 8 months or something like that. So the federal government has a plan where you can go into forbearance, and this isn't going to have a negative impact on your credit, so that's good. And forbearance is pretty much saying, okay, we're not going to say that you have to make a payment. You don't have to make a payment, so that's good. But a big but, the interest will accumulate on the loans that you've taken out. So that's some things that you have to kind of keep in mind. Is yes, you can go into forbearance, and you can, not really take a hit in terms of credit. But at the same time, the interest will accumulate if you do go into forbearance. That's something to keep in mind there. Let's say you graduate and you have, let's say, $29,000 in loans or so, but your income is about $26,000 a year. So in that case, it might be very difficult to make monthly payments of, $300 a month. So then you might be able to go on what's called IBR, income-based repayment, where it could be about 10% of your income that you're contributing towards the student loans. So I think that there are other ones, but I think the main ones I want to make sure I talk about. The key thing here, though, is that with these plans, when you do make these kind of adjustments, you might be delaying like a payment. So then there might be more interest that accumulates over time. And let me go ahead and talk a bit about the forbearance. So right now, we are going through like an automatic forbearance through the federal government. And this is working a little bit differently to the forbearance that I was just talking about. So what's happening right now is where the government's like pretty much saying, okay, right now, all your student loans, I shouldn't say all because certain things like the Perkins loan don't qualify for this, but assuming that everybody that's listening to this is currently an undergrad here, or even a grad student, in that case, all your interest is going to be sitting at 0% until October 1st. So there's no interest accumulation. So, if you have the money or if you've been working and you have some extra money to kind of put towards your loans, right now could be a pretty good time to pay down some of that debt as well. Did that cover some of the things that you wanted me to talk about, Bill?
Yeah, no, that's awesome. And just to clarify, so any student that might be facing any of that, the discussion isn't with UMass, it's with the loan service provider to address talking about those plans. Is that correct?
Yeah. So this is all with your servicer. But if you have any questions that come up and you're not sure about something, you'd rather talk to us, you can definitely reach out to us at UMass Financial Aid, and then we can go ahead and help you navigate whatever circumstance that you're going through. But in general, yeah, it's pretty much a servicer. So yeah, did you want me to go ahead and keep talking about kind of like the deferment and then how
Yeah, for
forbearance
the,
works?
if you want to go to the next one, it talks a little bit about like making plans and stuff like that. Um, and then I can hand it over to Ben to kind of finish off the student loan thing, but you're more than welcome to talk about some of the deferment options and any of the like loan forgiveness through the public sector or anything there.
Yes. I'd love to keep talking about that. Somebody just came in through the front, just because I'm in the office physically. So I know that you usually do this presentation. So Bill, can I pass it back to you, and then I'll probably come back if there's anything that you want me to add, I can add in.
No problem.
Awesome.
So yeah, so making a plan to pay off your student loans, this is really important, and Ben will touch on more of this, but using your grace period, which is the 6-month period that Kael was talking about, and not going below that. If you have, your grace period won't be as long, but taking advantage of that to kind of get your financial house in order before you start using some of those, starting to qualify and start making payments. And then research your loan. So understand, like Kael was saying, understand where your loans are, understand kind of what the interest rates are, what the payments are going to be, find that through your loan servicer or your private lender. But yeah, there's some tax credits and things like that and deductions I'll let Ben go more into depth with.
Okay, here we go. Yeah, so there are a couple of tax deductions that you can get for making your student loan payments, particularly the interest. That's a common form, which we'll get into later, the student interest tax deduction form. There's a couple of other types of payment plans that Kael didn't mention that we're going to go through. So here is the standard repayment plan. This is just with, so the loan details are on the left where it has a $20,000 loan amount, a 5% interest rate for the standard 10-year repayment period. In this case, the monthly payment is $212. And as you can see, that light green is the amount of interest that you're paying, and the dark green is the amount of principal. And so as you get towards the end of your loan, the amount of principal you're paying increases, as well as the percentage of your loan interest paying increases while your loan balance decreases. In this case, you're going to have a $5,455 amount of interest, which is what happens in this case is you're multiplying your loan amount by the interest rate. And so once you make your $212 payment, that balance will go down a little bit, and you'll pay the 5% on the new amount, which is going to be less than 20,000, and so forth as you keep going. And so as you start to pay this balance down, the amount of interest you're paying as a portion of your monthly payment will also decrease. And that's the case with all loans, but in this case, it's more of a straight line of your loan balance decreasing. Under the extended repayment period, you can go typically up to 30 years, the same $20,000 loan, same 5% interest rate, but instead of 10 years, you're paying it off over 30 years. And so in this case, your monthly payment is lower. It's $107. You're making 360 monthly payments, which is the 30 years times 12 months. But in this case, instead of the $5,000 of total interest, you're paying $18,651 of total interest. The reason here is because you're paying less per month, your loan balance decreases at a lower rate, and so your interest rate is going to be there multiplying a larger balance. So not only are you making more payments and more interest payments, but also your loan balance is decreasing at a slower rate. And so this is more of a curve. Graduated repayment. So with the same $20,000 loan with the 5% interest rate, if you got let's say a 5% increase per year in payments, you could start off somewhere in the middle instead of the $212 standard repayment or the $107 extended repayment. If you want to start off in the middle of that at $172, and you want to increase that 5% per year, let's just say you think you're going to get a raise or you think you're going to earn more towards the end of your payment period than the beginning, which is likely the case with most college students, the graduated repayment period may be the best option for you. Because in this case, you start off paying a decent amount, but it increases over time. And so these are some common repayment periods, along with the income base, which Kael talked about earlier, which is a percentage of your total income, as well as you can put your loans into forbearance or deferment. Is there anything else you want to talk about for loans?
No, I think you covered most of it. So we can always come back to that if Pilgrim's not gone, but go ahead and get into credit.
All right. Again, if anyone has any questions, feel free to put them either in the chat or you can unmute and raise your hand. All right. So building good credit. What is credit? Some people like to call it the worthiness to receive back and sort of pay back loans. It is a sort of a qualitative number to how likely you are to pay back loans based off of a certain set of factors. It's built up through all types of loans, such as student loans, credit cards, mortgage, auto loans, even such things such as like farm share loans or bike loans through a lot of credit unions will also count towards your credit score. The credit score is used to determine your interest rate and sometimes even the amount that they're willing to let you borrow. It's scored on a scale of 300 to 850, and a higher score means you have better credit, which means you're more likely in that servicer's eyes to pay back your loan. How is the credit score determined? The credit score is determined based off of 5 factors: payment history, amounts owed, the length of credit history, the credit mix, and the new credit. Payment history, the number one question is, are you making your payments on time? It's 35% of your credit score, and it's the most important part because if you're in that lender's eyes, are you more likely to give to somebody who has paid back loans in the past or someone who has missed a lot of payments in the past? In this case, you would be more likely to give money to somebody who has made their historical payments. And so that's why it's the largest portion of your score. Second, 30% is the credit utilization or the amounts owed. The credit utilization ratio is the ratio of how much you owe in terms of your credit compared to how much you could borrow in terms of your credit. You want to keep this percentage under 30% because anything over 30% will not necessarily hurt your score, but it also will not positively impact your score. the less you're borrowing and the less you're relying on credit for your sort of everyday needs, it makes you look less risky in the lender's eyes. And so they want to make sure you're responsible using the amount of credit that they've given you. And the closer you get to your credit limit, the more risky it is for the lender. Length of credit history is how long you've held your credit. This is the most difficult for college students to overcome because most people are starting and they're getting their credit card for the first time. Their student loan history is only like at most 4 years. And so this is why some people encourage getting student credit cards when you're a freshman, because you can sort of start that length of credit history right in the beginning, and it will allow you to keep that 15% up over time. Length of credit history is not entirely the most important factor, but it is a significant portion of 15%. Credit mix are the types of credit you have. And so that could be anything such as an auto loan, a mortgage, a student loan, a credit card. How many types you have makes you look like a more mature borrower, and the more mature borrower you look, and if you're able to access all those credit lines, you're more likely to pay it back. And that's all it really comes down to, is how likely you are to pay back these loans. New credit is how often you've applied for new credit. A recommendation here is to not apply for more than 2 or 3 credit cards or lines of credit at the same time, because it makes you look desperate in the lender's eyes, and people who are desperate for credit are more likely to not pay back their loans. So applying for just a couple of credit cards at the same time won't hurt your score nearly as much as applying for like 5 or 6. All right. Is there anything, Bill, that you want to add to that?
No, I think you covered it.
All right.
I could talk about how student loans could have an effect on your credit score as well, if you haven't covered it.
Yeah, we haven't covered that. That'd be great.
Awesome. So with student loans, let's assume that during your freshman year, you took out like an unsubsidized loan or something like that. So that goes on your credit report. So that's something that's going to give you some credit history, right? So that could be good in terms of improving your credit score. And there's a couple different scenarios, I guess, but let's assume that your freshman year took out an unsubsidized loan, a student loan, and you never took out a credit card, like you have nothing else in your credit report. Like the student loan is the only thing that you have in your credit report. So let's say that you hit senior year and then you graduate, you work for a couple of years, your student loans aren't paid off yet, and then you have like a lump sum amount of cash, and then your plan is to pay off the student loan. So you could go ahead and pay it off. But when you do pay it off, it actually has an impact on the overall credit history in terms of like the average age of credit and things like that. So you might actually see your credit score drop pretty significantly for that time period. So some things to keep in mind if you are in that situation is, maybe leaving, pay it down and just leave like maybe $500 or something that you can easily pay off, and then go ahead and apply for whatever loan that you might be looking for if you are looking for a loan, right? So this is only important if you're looking for a house, you're buying a car, and you need a loan for that. So those are situations where this might apply. If you're not planning on doing any of those things and you're just renting an apartment, absolutely go ahead and pay it off. But I just want to make sure that I mention that if you don't end up having like a credit card or any kind of any other forms of credit on your account, then if student loan is the only thing on there, you do pay it off, and it can have a negative impact in that short term if you don't have anything else. So I just wanted to make sure I mentioned that.
But yeah, that's really helpful. A lot of students don't realize that they may already have a credit score based off those student loans. And if they haven't been paying them back, it may be a lower amount, but once you start paying those back, you'll get that payment history, and you'll also have that length of credit history. So thank you. Some tips for building good credit. Missing payments really hurts you in a number of ways. It hurts you both in payment history, it hurts you in credit utilization, and those are the 2 biggest factors. And so it hurts you in the payment history because if you're over that 30-day mark, it shows you're not making your payments, and that will negatively impact that 35%. It'll also hurt you in the credit utilization because that interest on, even if especially if it's a credit card, will significantly increase your amounts owed, which will hurt your credit utilization ratio. For example, if you had, let's say you had $1,000 credit limit and you were good, you only spent $250, which is under your 30% mark, but you have a 20% APR. And so if you don't make your minimum payment, or even if you don't make any payment, and you let that interest accrue, you may be over that 30% mark in the next month, which will negatively impact you as well there. Another good rule of thumb is to not have more than 2 credit cards open at a time. This is something we recommend because it's really hard to keep track of it all, as well as having too much credit can be not necessarily a bad thing, but many students aren't able to sort of control that much credit at a time, and so they take on too much debt in terms of revolving credit, and those APRs, if you're not making the full payments, can really impact you. Um, Knowing your credit score, there's two sites we like to use for that, which is our annualcreditreport.com, which will give you a copy of your credit report from each of the 3 credit bureaus, as well as Credit Karma, which will give you uh, a range, not really a range, but a sort of a snapshot of your credit score based off those 5 factors from the information that they're able to obtain. Kael, is there anything else you want to add for the credit section?
Didn't realize I was on mute there. So in terms of how it ties with student loans, no, I think everything's covered. Yeah, it's good to go, I think. Thank you.
Right, thank you. So, Bill, you want to cover tax filing?
Yeah, so we're going to talk about taxes now and just kind of go into the segment about what to expect when you graduate, realizing that now you do have to file taxes, especially because your employer will be paying you a wage that, because you might have been able to get away with it in college, you might not have been earning so much money, but at this point, you know, when you accept a real full-time job, you'll likely be earning substantial income compared to what you usually earn, and that will require you to file a tax return. So we'll go ahead and get into that. So some good things to know is that in general, your tax deadline is April 15th. That's just a universal thing, happens all the time. This year, however, though, with COVID, they've moved it a month back. So it's now May 17th. But just to know that generally your filing deadline is April 15th. Post-graduation, you're gonna wanna look out for different forms that are sent to you by your loan service providers as you start to make payments. In the general note, they'll start to make payment, notice that you're going to start owing payments, but also as you make payments, you'll be able to, in some cases, deduct the interest from your student loans on the taxes that you're paying. So keeping track in general of large expenses, interest charges, like if you own a home, deducting your mortgage interest, all those things, keeping track of them on your own and creating your own, spreadsheet or writing them down is paramount to putting you in a good position when it comes tax time, because there's a lot of forms that are required. And if you can have some of this information readily available, it goes a long way. So in the next section, we'll talk a little bit about forms and some of the requirements there, what will be sent. So I'll touch on Kael here. We'll talk about the 1098T and the 1098E, which are the 2 different forms. The T's for tuition payments, so you might not run into that so much as you're getting out. But Kael, if you have anything to add about, tax forms that will be sent, who they'll be sent through, will they be sent through UMass? Will they be sent through your loan service provider? Any of that information would be great. And what happens, if you have those loans and you go to graduate school?
Yeah, so for like the 1098T that gets sent out through UMass Amherst, actually, it's the bursar's office that puts that together. Any 1098T documents that would come through them, and then you'd be able to use that when you're filing taxes. So if you're using, let's say, TurboTax or something like that, it's going to probably say something like, please enter your 1098T values here, or it might say, just take a picture and then we'll be able to kind of complete the rest. So that's one thing that might happen through the university. The other thing that could happen down the line in terms of taxes is, let's say that you went to medical school or grad school, right? And total student loans, let's say you have about 50,000 or something like that. And if these were unsubsidized loans, there might be a good chunk of interest that accumulated on those unsubsidized loans. So the interest that accumulates and then you make payments towards them can benefit you in terms of when tax season comes. These are things that you can definitely consult with your accountant too. But who can afford an accountant, right? Right. So if you're doing it on like TurboTax or whatever free software that might be available through irs.gov, if you're making less than a certain amount, then the system's going to automatically complete those things for you, and it'll be pretty seamless, and it'll be an automatic benefit that you'll be able to kind of use. In terms of like a financial aspect, it's not absolutely massive. It's not like necessarily a game changer, and it's not like you should have student loans and pay interest on it because of the tax benefit. I don't think that at all. I think it's better to not have student loans, right? So that's kind of, I guess, overarching information in regards to how that might play out.
Yeah, no, that's super helpful. And to touch on the other ones, like a 1099 INT will be sent through an institution like a credit union or a bank. If you have like a high yield savings account or a money market account, you do have to pay interest on whatever money you're earning on that. They send out forms. So look out that through your online banking inboxes or in your mail. 1099 MISC are miscellaneous forms. If you have a Robinhood account, you'll get a 1099 miscellaneous. Depending on the type of work that you do, you could also be like contracted and they'll send you a 1099 miscellaneous instead of maybe a W-2. So always look out for those forms, depending if you do contract work or if you worked like a short internship or something like that, they can always send you a miscellaneous form. 1099G is especially relevant now because students that might have received unemployment income, you'll need to include that in your tax filing as well. They recently passed a sort of a deduction for 10,200 of unemployment income just for this year, but 1099Gs for any time you go on unemployment, and then your most important one is probably your W-2, which holds most of your income if you hold just a traditional job that pays you through W-2. And then just keeping track of like HSA savings account, which are health savings accounts, 529s, IRAs, 401ks. These are all good things because they help to lower your tax income burden, like Kael was talking about, doing that for interest. And you don't want to just take out student loans to get those write-offs. But in these situations, as you begin to save and make investments in things, there are great tax advantages. And Ben will touch on those later on in the presentation when we get into investing. But this is just some common things that you'll most likely encounter as you get out of college or as you begin to enter the workforce. Cool. And then services and assistance. This is our last tax slide, which talks about the fact that taxes are complicated. The more money you earn as you purchase homes, cars, and pay off some of your student loans, it gets quite complicated. So there's a bunch of different resources at your disposal. Like Kael was saying, it's expensive to have an accountant. So if you can do it on your own and you feel comfortable, most of the softwares walk you through everything and make sure to see if you have these forms. You can go to the irs.gov/free file, which talks about how to file your taxes for free and what software is available to you for free. There's also services through like the IRS that are associated with VITA, which is a voluntary income tax assistance program. And they work with people that need to file the taxes, answer questions. IRS.gov, although it seems like a government site, it might not have a lot of information or be hard to use. It's pretty straightforward. It has a lot of good information. And always ask a licensed professional if your situation gets complex or things like that, if you need advanced help. But we're going to transition over to the next aspect. But if Kael or Ben, you have anything to add about taxes or education or anything like that, feel free to go ahead.
All right. So planning for your future. there are a lot of things that come up with job searches and getting your first job, as well as living on your own, that you may not expect. Some common expenses you may not be thinking about are insurance costs. Insurances are expensive. They are probably one of your number one expenses outside of sort of basic living and car payments and car work. Um, Insurance such as health insurance, dental, car, life are important because you want to insure things that you can't necessarily afford outright on your own, especially if you don't have a large amount of savings that you can fall back on. Um, Most important are probably health, car, and life insurance. If you, those are all things that you should probably talk about with immediate family and with dependents or even with parents. Health insurance may be offered through an employer. It's important to ask, important to figure out what benefits you are entitled to, as well as dental. Car insurance, there's a whole bunch of car insurance companies out there. They may not offer you the best rates, especially if you're a young driver. Those sorts of car insurance rates, though, can be bundled with things such as renter's insurance or homeowner's insurance to get a lower rate. So it's important to ask if you already have car insurance when you do go out and live on your own, that you try to sort of increase your savings by bundling your either your home, auto, life, and those sorts of things. Commuting costs are something that a lot of people don't take into account. For example, if you're working in Boston and you can't afford Boston rent because a lot of people can't, and you want to move to, let's say, the South Shore, you move into Braintree, you have a 15-20 minute commute on a typical day, but if you're going at rush hour, it may cost you not only 45 minutes of your time, but it'll also probably take a quarter of your tank of gas. On top of that, if you're not into driving and you live near public transit, those public transit costs are also expensive in terms of parking as well as actually paying for your ticket. A lot of companies nowadays will offer reimbursements for commuting, so it's important to ask about those as well, particularly for public transit commuting. Rent, utility, and food costs. These are your big three in terms of your big expenses. Rent in particular, you're going to want to have your rent be around hopefully less than 30% of your income. That's not the case in a lot of places, but if you're able to have roommates in order to keep that rent down, it's something that you should keep in mind. Utilities are also important. Figuring out what is included in your rent is key. A lot of people don't factor that in. With things such as Wi-Fi, heat, gas, water. If you're in Massachusetts, trash and sewer should be included. But if you're not in Massachusetts, you should think about trash and sewer fees, as well as other fees such as parking or pets. Um, common common utility fees. Keeping those costs down. For example, electric heat typically costs more than gas heat, but you use your electric for other things. Food costs as well. Buying in bulk is a common way to save on that. But if you're not able to buy in bulk, buying local will also likely keep your costs down compared to buying a lot more either takeout or going out a lot. Student loan payments. You likely haven't had to pay your student loan payments yet if you're looking at this presentation. Keeping in mind that you need to save roughly, as we looked at earlier, could be anywhere from $100 all the way up to $250, depending on which payment plan you choose. If those aren't options for you, looking at the income-based repayment plans is something you should keep in mind. Adhering to the 50-30-20 rule if possible, that would be 20% of savings, 50% on necessities, and 30% on other. The 50-30-20 rule is sort of a basic framework. In the end, the goal is to have 20% savings, but sometimes that's just a dream. The 20% savings is going to go into something called an emergency fund, which we're going to get into a little bit later. Retirement accounts. The two most common type of retirement accounts are employer-based 401ks as well as individual IRAs. The IRA literally stands for individual retirement account, and a 401k is the tax law on that. A lot of employer-based 401ks you'll learn about in your onboarding process at your new job. It's important to ask about matching policies in this case, because a lot of employers will match you, for example, 3% of your income, or 5%, and that's pretty much free money to put towards your retirement. A main difference is the 401k has a larger annual limit than an IRA, and both have tax deductible options, so you're able to lower your taxable income if you're using um, a traditional compared to a Roth. A Roth option is, so for example, in a traditional 401k, you put your money in tax deferred. Tax deferred means when you put the money in, it's not taxed yet. So if you were in the 22% tax bracket and you put in $1,000, you would be putting in the full 1,000 instead of, I think it's 780. So that money can grow quicker. When you withdraw your money, typically at age 65 and a half and older, you are going to get taxed on that withdrawal. With a Roth option, your tax is done up front. And so your money grows. And when you withdraw, you don't have to pay that tax. It's a key difference. Typically, if you are expecting to be in a lower tax bracket in the beginning, you're going to want to choose the tax deductible standard option compared to the Roth option, because you're going to want that money to be taxed in the end rather than in the beginning. IRAs have more options. In both cases, you're going to be able to pick between a plethora of funds to choose from. There's a lot to get into on that, but they'll give you more options in an IRA than a standard 401k. Kael or Will or Bill, is there anything else you want to add to that?
I can kind of hop in and talk a little bit about something that you touched on with car insurance, because I have an interesting personal story to tell with that one. So with the car insurance that you were talking about earlier, I think a big thing is, or what I personally learned graduating from undergrad, is that it's good to shop consistently, maybe once a year, maybe once every 2 years, maybe once every 3 years. And right, you want to kind of get everybody to bid to see who has the best offer, right? And then you can eventually pick the car insurance company that you might want to go with. And car insurance companies have tactics to keep people. So straight out of undergrad, I think I was with Progressive, and because I stayed with them for a while, they would keep upgrading you to like Emerald, Diamond, and Platinum Elite, or whatever title that they might create, right? And there might be certain benefits associated with that, like, you know, major accident forgiveness or something like that. And it seems good, right? But what's actually happening is they're creating a sense of attachment. And in the meantime, they're actually jacking up some of these rates. So if you go shopping, then you might be getting 3 different offers that are 20% lower. You could switch, or you could go back to your original insurance company and call them and you say, hey, look, I'm thinking about changing insurance companies. It looks like they're offering 20% less. Or you could lie and you could say they're offering 30% less, and then see if the original company could go at a lower rate, right? Like this is like normal negotiation. And they might say, okay, like we want to retain you and let us go ahead and reduce your rate by, 25 or 30%. They might kind of go back and forth with you, and then you can secure a better rate. So that's something that you can definitely do. And it's a big money saver, because if you don't do anything there, I can guarantee you they're just going to keep increasing the cost throughout time. So that's a tip that I kind of learned myself.
Yeah, that's great. I see a question in the chat from Val. Will employer-based 401ks, are they invested or do they just go into retirement savings? So a 401k is intended to be invested in different types of funds. Those funds are made up of a lot of different stocks or bonds or the combination of the two of them, and they're intended to serve a certain purpose. So you might invest a certain amount in a US based fund or an international fund, and within those you can go with smaller companies, bigger companies, certain growth companies. You can also invest in age ranges. So if you intend to retire at the age of 70 and you want to put your money in a target fund, is what it's called, it will change your risk compared to how old you are. And so the person actively managing it will change your what you're invested in over time. So in the beginning, you might have a little bit more risk because you're younger, you want to grow it faster. Compared to when you're older, you don't necessarily want to take that risk of losing the money, so you want to be a little more conservative with it. And so it's important to, when you're choosing those things, to sort of understand what your financial goals are, and particularly in retirement accounts, the biggest goal is almost when you want to retire rather than how much you want to have when you retire, because it will choose how risky you want to be with those investments. You can invest in stocks, you can invest in bonds, you can invest in mutual funds, which are collections of stocks. You can also have cash in your 401k, but it won't grow at the rates that invested monies will, if they do and grow. You're not necessarily insured in these 401k accounts, so the money can go down, but the entire point of the 401k is to invest it. Same with an IRA. An IRA is the same sort of deal. You'll have more options to choose from. It won't just be stocks, bonds, mutual funds. You'll be able to invest in real estate and all sorts of other things with your IRA money. But they're not necessarily intended to be like a savings account rather than a brokerage investing account. Okay. Accomplishing financial goals. An important thing is to sort of see your big picture, and using the acronym of SMART, using that as a method for goal setting is a key aspect of financial wellness, in terms of the budgeting and goal setting process. SMART stands for specific, measurable, attainable, realistic, and timely. An example of a SMART goal is I want to retire at the age of 65 with $400,000 by investing $200 a month into my 401k. That hits all the factors. It's specific. It has a certain time period. It is realistic. Maybe not right now, but maybe if I started like a couple of years, it hopefully is attainable if you do some of the calculations out, and it's measurable. You can see if you're really putting in that money. You can see how that money is growing. And goals are not a static sort of event. Goals are fluid. They change on your personal situation. If you get married, if you have a kid, if you move, if you change jobs, those goals will likely change over time. And so, but having that initial goal will allow you to sort of set your budgets in a direction that will allow you to succeed. If you're just sort of throwing money out there and hoping it's going to do something and not really having a plan with that, you might be a little more frustrated or confused on where that money is going. If you're sort of intentional with those SMART goals, and you set a specific amount and you set up accounts based around those, you're more likely to achieve them. Some common steps to continue your SMART goals: setting up yourself with a bank or credit union that has free tools. For example, Bank of America has budgeting tools. UMass 5 has budgeting tools. A lot of banks have budgeting tools. They also let you to set up different types of checking and savings accounts, such as kitty accounts or goal set accounts for specific purposes. For example, if you're planning a vacation, you can set up a checking account, not checking, a savings account specifically for that purpose under your name. It's a common way for people to set money aside financially. Um, Figuring out your student loan servicer. We talked about that earlier. Starting to make those small payments, even if you're just paying interest, it goes a long way. You may not have noticed it in the beginning, but the large portions of your initial payments goes towards the interest that's already accrued on your account. If you pay $100 in your first payment, maybe $5 of that goes towards your actual principal. And so making some small payments while you're in school or setting a little extra aside for payments when you're out of school can help you save a lot on that accrued interest, as well as shorten the length of time that you have to be paying that loan off. Practice saving. People like to say, sort of practice what you want to do. Setting a small portion aside, even if it's just a couple dollars, will sort of set the foundation for future savings goals, and sort of striving for that 50-30-20 rule, and building up to that 20% portion of savings. Start that savings should start an emergency fund, which is 3 to 6 months of your living expenses. Emergency funds are really important because it allows you to, if you have a job change, if you have your car break down, if you have an unsaid medical expense and you don't have the much enough for your deductible, your emergency fund is there intentionally for that purpose. And so initially, as college students, 6 months is a lot of money. Start with a couple weeks, start with a month, work your way up to 3 to 6 months. And so starting to put money aside into that fund will allow you in the future to sort of achieve your goals, even if you have setbacks.
I could start on the resources. So there's two different things. Reach out to Sam. Obviously, we're creating presentations like these, but during COVID, we're also doing virtual office hours and drop appointments. And then financial aid office is meeting with students virtually as well, to go to them for questions about loans, your award letters, things like that. Even post-graduation, as Kael's mentioned, they're excellent for that. You can always follow up with them and ask questions. Kael and myself also just recorded a podcast called Student Loans After College. You can find it on Sam's social media and everything in the coming days, as well as by clicking on the link or going to Student Success's YouTube channel. It will show all the different videos recorded, but also the podcast, which is really in-depth conversation that we had about student loans, expanding even further on the conversation we had today. And then the U.S. Department of Labor and Education is also hosting a webinar coming up with Your Financial Future Starts Now. You can register that at the link below. And it just talks about how to, life after college sort of, and understanding your student loans in a different aspect than we would have talked about today. So with that, I'll hand it over to the other Ben and Kael if you have any other closing remarks.
I think I'm all set. I think I kind of covered everything in terms of student loans and things like that. So we should be good to go.
Yeah, I'm pretty much all set. We're gonna put the link in the description of the video. It's gonna be on YouTube. The key thing I think we should take away from this is sort of just not starting as soon as possible, but sort of getting an understanding of your situation earlier will definitely help you in making these decisions later. Sort of, if you have a job now, asking your employer about those matching programs. If you have student loans, researching your service or understanding what your payment's going to be and how that influences your budget now instead of when you get to that point really helps you, and sort of starting that communication early if you're not able to make those payments, and sort of switching to a different payment plan with your servicer will also help you do that. Realizing how credit impacts your life, starting a credit card, even if it's just a secured card or a small loan, in building up that credit score will also help you saving money later. And so there's a lot of things you can sort of take away from this, but starting early and understanding how your goals will impact the rest of these decisions is really important to take into consideration. And thank you. Follow us on Instagram at UMassSam. We're also on Facebook. And if you have any questions, feel free to email us at smartaboutmoney@umass.edu.